Hello, and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you joined us for our 11th Spring Banking Conference. Our first live presentation of the day is from First Resource Bank. Please note you may submit questions for the presenters in the box to the left of the slides. And you can also view a company's availability for one-on-one meetings by clicking Book Meeting in the top toolbar. At this point, I'm very pleased to welcome Lauren Rinaldi. She's the President and Chief Executive Officer, and Kristen Fries. She's the Chief Financial Officer of First Resource Bank, which trades on the OTCQX Best Market under the symbol FRSB. Welcome back, Lauren and Kristen.
Thanks, John. Good morning, and thank you for joining us today. I'm Lauren Rinaldi, President and CEO, and as well as co-founder of First Resource Bank. I want to take a minute to look at our forward-looking statement disclaimer here, and then let's get right into the presentation. First Resource Bank was founded in 2005, and we formed a holding company, First Resource Bancorp, in 2022. We operate in southeastern Pennsylvania with 3 physical branches and a separate corporate office. We operated as a single branch bank in Exton for our first 10 years, opening the Westchester branch in 2015 and Wayne in 2019. We ended the year with $664 million in assets. We are a high-touch bank, providing excellent customer service. Over the years, we have referred to our operating strategy as a hybrid community bank. We are very much a throwback community bank in a lot of ways. Think about the movie, It's a Wonderful Life. But we can also provide all the technology bells and whistles that today's customers need and expect. It's a high-touch environment where we can also deliver those all-important tech tools. Our executive management team includes seasoned bankers, many of whom have been with First Resource for a long time. Over the past year, quite a few of us have changed roles as we have executed on long-term plans regarding expected retirements, most notably my co-founder, Glenn Marshall, who served as our CEO for our first 19 years in business. Glenn and I founded the bank together back in 2005, and I served as CFO for the first 15 years, and then president and CFO for the following 4 years, before taking on president and CEO last April when Glenn retired. Most of the officers on this table have held different roles within the bank in addition to the role that they now hold, which has created depth among each role and department. We've had a lot of success developing team members who have earned promotions across the bank, and this executive team is no exception. When we need to go outside the bank for expertise, we're not afraid to do that either. Most recently, Jennifer McMullen joined our team from a competitor, bringing vast knowledge of the retail space. This team has the knowledge, drive, and enthusiasm to keep propelling our growth in the future. The team's energy is palpable as we take on 2025. A quick look at the map of southeastern Pennsylvania. As you can see, we operate in suburban Philadelphia with our 3 branches in Exton, Westchester, and Wayne, with each location noted by a red $sign on this map. The triangle formed by those 3 offices covers approximately $15 billion in deposits. This is a prime market ripe with opportunities. We operate a branch-light business model, which allows us to focus our resources on hiring high-quality talent and continued investment in proven, cost-effective technology. We are not opposed to additional branches, but we will be very selective in which markets we will expand to physically. With an average of $184 million in deposits per branch in our current branch-light model and $15 billion in deposits in the market, we feel that there is still ample opportunity to grow deposits in our existing market without adding the incremental overhead of more physical branches. Sending our experienced business development teams out to the customer has been a successful strategy to bring the bank to them as compared to building additional physical branches. And now I'm going to hand it off to our CFO, Kristen Fries.
Thanks, Lauren. 2024 was another strong year of results for First Resource Bank. It was a challenging interest rate environment for community banks, but our 10% total assets growth helped us generate a return on average assets of 0.87% and a return on average equity of 10.91% for the year. These returns were down compared to the prior year, but still very strong in light of the operating environment and an isolated credit issue that Lauren will talk about later. Additionally, book value per share grew 12% during the year. Other notable items from 2024 include the issuance of $2.5 million in subordinated debt and a new 5% stock repurchase program. Now let's take a look at the balance sheet. While many of our peers pulled back on growth over the last 2 years due to liquidity concerns, we were focused on growing in a prudent and profitable manner, taking advantage of opportunities in our market resulting from merger and acquisition disruption. Total assets grew $61 million or 10% during 2024. Our asset growth was fueled by organic growth in the loan portfolio, consistent with most years on this chart. We are in a highly competitive market and have had to fight for deposits since we opened almost 20 years ago. Our competitive edge is the stellar customer service that we provide, and we continue to see success in winning over new customers. Total assets were $336 million at the end of 2019, and they are almost double that amount now. Our involvement in the Paycheck Protection Program during COVID helped us convert PPP customers into full relationship customers, driving our growth.
So let's look at the balance sheet in detail, starting with the loan portfolio. Our legal lending limit was just over $9.6 million at year end, as compared to less than $2 million when we first opened in 2005. We currently have a house limit of $9 million per borrowing relationship. Our loan growth has been aided by our higher legal lending limit, as we are better able to compete for high quality credits, which tend to be larger deals. Loan growth has been robust for the past 10 years, averaging 14% annually. All of this loan growth was organic, aided by some loan participations from other community banks, but there have been no loan pool purchases to date. Every loan we have on our books has been fully underwritten by our lending and credit teams. Total loans grew 13% in 2024 to $598 million at year end. And the vast majority of that growth was in commercial real estate loans, with net growth of almost $68 million or 16%. The commercial loan portfolio grew a healthy 19% to $60 million at the end of the year. Now, conversely, the commercial construction loan portfolio declined $9 million or 19% in 2024. Many of our construction loans were expected to move to permanent financing within the bank once the construction phase was complete, and that's exactly what happened. We have a reputation in the market for being excellent to work with on construction deals, as this is a core competency of ours. Growth in this area was fueled in part by investors purchasing older apartment buildings, renovating them, and then in return earning higher rental payments. Also, the continued lack of 1 to 4 family housing inventory in our market has turned some buyers to building their own homes or renovating existing homes. Despite our significant growth, our geographic reach has been consistent. In general, our loans are primarily within an hour to 90-minute drive from our headquarters in Exton. As of December 31, 2024, 92% of our loan portfolio was in Pennsylvania, with 4% in Delaware and 4% in New Jersey. And these data points are consistent with the prior year end as well. The Pennsylvania portion is broken down further as 56% in Chester County, where we are headquartered, 16% in adjacent Montgomery County, 8% in adjacent Delaware County, 4% in Lancaster County, 4% in Philadelphia, and the remaining 4% in other local counties. Our CRA assessment area includes Chester, Delaware, and Montgomery counties, and approximately 80% of our loans are in that CRA area. In addition to growing the portfolio 13% last year, we've grown it without sacrificing credit quality or sacrificing rate. We implemented a pricing discipline in the second half of 2023, which is still in place today, which ensures that we are not buying volume by being the lowest cost provider locally. We compete on service, and our growth has not slowed as a result. This next slide shows the breakdown of the loan portfolio as of year end. We are a business bank, and the vast majority of our loans are commercial in nature. Commercial 1 to 4 family residential loans comprise the largest part of this pie chart at 29%. These loans typically represent investor 1 to 4 family residential loans. We have a large following of customers that buy and renovate homes for their rental portfolio or resale. This has always been a core competency of the bank, and we consider this type of lending as fairly low risk. Commercial real estate owner-occupied loans make up 20% of the portfolio. And these are simply loans to business owners who own the building that they operate their business from. These owners typically like to have control of their building and the ability to build equity. This portfolio is fairly evenly split between office, retail, industrial, and flex space loans. Commercial real estate owner-occupied is also considered a low-risk portfolio due to the owner-occupant. Commercial real estate non-owner-occupied loans make up 17% of the portfolio. And as that portfolio has grown, we've continued to refine how we look at CRE loans regarding square feet and purpose to monitor concentrations so that we don't get overweighted in any one industry or type. We're currently monitoring commercial real estate by 35 subcategories, including flex buildings, office, retail, industrial, and other smaller categories. A great deal of this portfolio is mixed use, which diversifies the risk. Retail exposure totals 5%, which is everything from tire repair centers, bars and restaurants, small shopping centers, and retail with apartments above them. Industrial and warehouse loans comprise 5.5% of the portfolio. There's significant value to these properties with outside parking in particular, which are in short supply locally. Flex buildings, which are typically one-story office warehouse combos, comprise 2.2% of the portfolio, and non-owner occupied office loans are 1.9% of the total portfolio. These office loans range from small office condos to offices with apartments above them or offices with a restaurant and one-story office buildings. Multifamily is up next at 14% of the portfolio, and the vast majority of these loans are in Pennsylvania. There's been a fair amount of growth in this category in the past few years, as we had the ability to add larger loans in this area where we typically didn't have a lot of exposure. In the past, these loans had typically been 5 to 15 unit apartments, but we've had opportunities to participate in larger projects with fellow community banks as our legal lending limit has grown. Construction loans make up 10% of the portfolio, and typically these are rehabs going into the commercial 1 to 4 family residential portfolio to be rented or resold. We cater to spot lot builders who build less than 10 houses a year for sale, as well as construction of commercial buildings likely headed to the commercial real estate owner or non-owner occupied portfolios. These construction loans are feeding the CRE portfolio. This is a core competency of ours as well, and we continue to operate in this space as a trusted lender to local builders. C&I loans represent 7% of total loans, and these loans are typically working capital lines of credit, term loans for equipment, or any other credit needs related to a business. These loans typically come with robust deposit relationships as well. Consumer loans represent only 3% of the loan portfolio, and that portfolio continues to run off. We have no plans to expand into consumer lending at the moment. Asset quality has been very strong over the past few years. In 2022 and 2023, we actually generated net recoveries each year, with a low level of non-performing assets. Our weighted average charge-off rate over the past 10 years has been 3 basis points. In 2024, we identified one commercial customer that experienced significant financial difficulty during the fourth quarter, and we recorded a $1 million specific reserve for loss on that relationship. This conservative approach to the specific reserve calculation is expected to cover all potential losses on this $1.3 million credit relationship. Despite this one credit issue, non-performing assets to total assets remains low at 19 basis points. We view this one loan issue as an isolated incident and not an indicator of any systemic issues. Unfortunately, loan losses are a cost of doing business as a bank, and we were a little spoiled for a few years. There's only one direction to go when you start at 0 non-performing assets. We are confident that our allowance for loan losses is appropriate for the level of risk in our loan portfolio.
Now let's take a look at our deposit growth. Loan growth must be supported by deposit growth, and deposits have grown significantly over the years. Total deposits grew $53 million, or 11%, during 2024. Strong growth in money market accounts and CDs was partially offset by a decline in total checking. We operate in a highly banked, fiercely competitive market. The first thing many deposit customer prospects want to know is what rate they are going to get on their account at First Resource. While we cannot always offer the highest rate, we have been able to compete on service as we still see significant disruption and opportunities from M&A transactions that occurred years ago. Also, the increase in fraud on business accounts has left customers of the bigger banks frustrated and looking for a local bank that is in their corner to help recover funds lost due to fraud. As Lauren mentioned earlier, we are a business bank, and our deposits reflect that, with 89% of our checking deposits being business accounts. Now, our money market and CD balances are more evenly split, with 58% business and 42% consumer. We're able to compete effectively on business deposits since so many of our peers charge excessive fees while also delivering subpar service. The First Resource Bank customer service experience, on top of virtually no fees, has proven to be a win-win combination for us and our customers. We have worked extremely hard as a bank to improve our funding mix by increasing the percentage of checking deposits to total deposits over the years. The yellow line on this chart shows that ratio over the past 10 years. Back in 2015, the percentage of checking deposits was only 12%, and by the end of 2024, it had grown to 23%. The peak in 2021 was fueled by the government-funded deposit surge during the pandemic years. The decline in the percentage of checking since that peak can largely be attributed to many depositors shifting their funds to interest-bearing accounts once interest rates increased in 2022 and 2023. We have a robust deposit pipeline and dedicated business development staff on board to help us continue to grow checking balances. In addition to wanting competitive interest rates, customers are also interested in excess FDIC insurance. As of year end, approximately 81% of our deposits are either fully insured or otherwise collateralized. We have been a member of the IntraFi Deposit Insurance Network since soon after we opened in 2005, so we've always been ready to address our customers' insurance needs. And one final point regarding our deposit mix. The spike in CD growth this past year was in response to our continued double-digit loan growth. In the absence of such strong loan demand, our reliance on CD growth would be reduced. As you'll see in the next slide, although we have incurred higher costs for deposits to support our growth, the pricing on our loans has sufficiently offset these elevated deposit costs. So now let's look at the margin. While the net interest margin in 2024 was lower compared to the prior year, we did see a positive trend of increasing margins throughout the year. As we mentioned earlier, we have implemented a strict pricing discipline on loans that has allowed us to grow the margin despite our elevated deposit costs. We have a loyal base of repeat borrowers who value the exceptional level of service they receive at First Resource and are willing to pay for it. Also, with an average loan size of approximately $340,000, we provide financing to small businesses and local real estate developers that feel left behind by the larger banks. This slide has a lot going on, but it really tells the story that no matter the rate environment, we have managed the balance sheet to achieve a net interest margin consistently higher than our peer group. The blue line shows the First Resource Bank margin, and the red line shows the peer group margin. The peer group changed in 2019 due to the bank's growth and is noted at the bottom of the slide. The left axis shows the First Resource Bank and peer group margins. The yellow line shows the average federal funds effective rate using the right axis of the chart. The straight line up represents the Federal Reserve tightening to try to get inflation under control. Deposit rate pressure is intense, and our cost of funds is higher than the peer group. But our loan yields are also significantly higher than the peer group due to our pricing discipline, which results in the net interest margin consistently exceeding peer. Now let's take a look at overhead. This slide has been included in every presentation we have done since our very first annual shareholders meeting, because overhead expense control has been of critical importance to us since day one. Our business model of maintaining a low physical branch count, coupled with an investment in proven, cost-effective technology, has allowed us to hire the best bankers out there to provide excellent customer service to our customers and still maintain lower overhead than our peers. This unique combination allows us to deliver the technology that customers expect, with access to a team of top-notch bankers to support our hybrid community bank model. Some companies are laying off employees to lower overhead, and we are continuing to grow the bank, which requires continued investment in our people. Yet we still see a decline in our overhead as a percentage of our assets, due to our growth. And with that, I'll hand it back to Lauren.
Anyone who knows me knows that I am fiercely competitive, and I wish this chart ended differently for 2024. Last year's results generated $5.3 million in net income, a 10% decline from the prior year. This decline is attributed to the $1 million loan-specific reserve that I mentioned earlier. The good news is that absent that one item, we would have had another record year. Our focus on consistent, prudent balance sheet growth has fueled our net income growth over the years. 2024 was a solid year, albeit not a record year, but the core banking earnings power that we've created has established a strong foundation for the future. Our board of directors authorized a 5% share buyback plan in August. And of the approximately 156,000 shares authorized to be repurchased, almost 97,000 were repurchased through year end. With our stock consistently trading at a discount to book value, our board of directors saw an opportunity to demonstrate our commitment to prudent capital allocation via this plan. Excluding our share repurchases in the market, our average monthly trading volume has increased by 56% since the plan began in August. We issued $2.5 million in subordinated debt in August as well. This small private offering carries a 6.5% coupon. This capital raise was the first time we raised subordinated debt at the holding company level, and we have the ability to downstream some of those proceeds to the bank to support its continued growth. One of our founding principles was always to be open to raising small amounts of capital as opportunities arise to take pressure off of a big capital raise down the road. And that's exactly what we did with this sub-debt issuance. Another item to note is that there have been 9 5% stock dividends issued since 2005. An original $10 per share investor at the bank's opening in 2005 now carries a cost basis of approximately $6.45 per share. We are laser focused on growing book value per share month after month. In 2024, book value per share increased $1.82 or 12% to $16.73 at year end. We refrained from buying large amounts of investment securities when the liquidity surge hit the industry in 2020 and 2021. And as a result, we did not suffer the massive mark-to-market unrealized losses that many of our competitors did. The unrealized loss on our available for sale portfolio represents only 32 cents in book value dilution as of the end of the year. We've been trading at about 90% of book value over the past few years. And as a thinly traded stock, we trade more on the perception of banks as compared to our own results, unfortunately. We are focused on continuing to grow the bank, sharing our story with the right audiences, like participating in events like today, and being good stewards of our capital to close the gap between book value per share and market value as an initial step. So looking ahead as we plan for 2025, we plan to keep growing organically at a similar pace as we've demonstrated over the past few years. Loan growth consistently outpaces deposit growth. Therefore, we have an internal focus on growing the C&I portfolio as these loans tend to come with sticky deposit relationships. Many of our CRE borrowers are what I call dirt rich, cash poor, meaning that when they have cash on hand, they tend to deploy it into their next real estate transaction pretty quickly. We will always be a real estate lender first and foremost, but our goal is to diversify the portfolio a little more with growth in the C&I portfolio. We have an initiative at the bank to integrate our lending and deposit calling efforts to ensure that we are gathering full relationships right at the inception of the customer relationship. These teams are working better together now than they ever have, which is very exciting for all involved. We recently hired a veteran banker from a competitor, and we are always open to bringing on the right talent, particularly when they can bring a book of business with them. Our reputation in the market is attracting high-quality bankers that are looking for a true community bank home. We do not have any near-term plans to open additional physical branches, but we plan continued investments in infrastructure, including personnel and technology. We are particularly excited about a manpower investment in an enterprise workflow product, which we believe has the potential to significantly limit our need for additional back office employees in the future. We have a blue tape initiative in place across the bank to identify process improvements and ways that we can continue to work smarter, not harder. We're all familiar with red tape and how it slows innovation and hurts morale. Blue tape is all about listening to the needs of the employee base and thoughtfully implementing process improvements where we can work more efficiently. We are small enough that we can get our arms around processes across the bank and make real change quickly. It's one of the things that I love the most about being a nimble community bank. If you've been on these presentations before, you know this slide. This is a photo of one of our employee outings. We love to dress in First Resource Bank blue and smurf it up, as we call it. When we go to a networking event, you can't help but notice all the blue in the room. I'm fiercely protective of the company's culture. As a founder, I've been at First Resource for over 20 years now. I still interview every single candidate before they receive a job offer. We take a lot of pride in being named a best place to work because that is only earned via an anonymous survey sent to all employees. We listen to their feedback and have implemented changes where feasible. We truly believe that taking care of the employees results in employees taking care of the customers. I could fill this slide up with all the accolades we've won over the years, but I'll just share that we've won the Best Bank of Chester County for 8 consecutive years and Best of the Main Line for the past 4 years. Every banker says that they have excellent customer service. The First Resource Bank team truly goes above and beyond at every turn to outservice our competitors. Our employees are invested in our success, and it shows. I'm so grateful for our customers who take the time to share their experiences with us online. Our employees are actively asking for the reviews and seeing success. Each of our locations has an incredibly high rating. As a matter of fact, we've received 2 more reviews since we submitted the slides 2 days ago. But these rave reviews across our locations are a source of pride across the company, and it's evidence of what the team is doing day in and day out for our customers. Every week, I share any new ratings with the entire company in a weekly email communication, and I email each reviewer a personal thank you for taking the time to write about their experience with us. Creating raving fans not only creates lifelong customers, but it also helps to generate new business. The banner ad at the bottom of this slide is a recent billboard ad we ran touting the benefits of working with a small bank like ours. So this next slide has our contact info. I'm going to leave that up while we look in the queue for some questions. So let me see what we have out here. First one, do we provide loans outside the USA? We do not. There's a question about if rates stay the same in 2025, how does that affect our margin and spread? You know, what kind of net loan growth are we looking for in 25? You're going to see continued double-digit loan growth from us. That is our plan. It's our theory is if you're not growing, you're dying. So you're going to see us continue to grow at the same clip. So if we ended the year at almost 600 million in assets, I would expect to see a minimum of 60 million in loan growth next year. Now, if rates stay the same, that's good for us. I mean, that's a scenario where, you know, bankers don't love volatility. So if rates stay the same and we can plan accordingly, that's a good thing. But also what's a good thing is that all the loans that we did in 2020 and 2021 that were 5-year resets all have significant upside potential as we approach the end of this year and next year in particular. So we think that that's going to be a really nice tailwind for us as we go into the new year. And when we did those loans back in 2020 and 2021, we underwrote them with a plus 400 rate shock. So we know that the credits are going to be able to tolerate the rate hikes, and we're excited for them to start repricing. So with that, I think we're going to wrap up. Thank you so much for your time today. We really appreciate your time and attention. If you have any other follow-up questions, please call, email, we're available. Thank you.